All right, cool. So fundamentals is my favorite. I truly enjoy fundamentals just because I get to know the grand scope of things, and I'm able to truly get the big picture. Fundamentals is pretty much a everyday thing. I mean, we wake up, we brush our teeth, we go to our cabinet, and next thing you know, we want to eat some cereal, right? And then next thing you know, we look at all the cereal, all the different kind of cereals, and then we choose one, right? Particularly, why did we choose one? Well, because it tastes good, it fills you up, and whatnot, right? But what made you choose that particular cereal versus all the other ones? And so that's the kind of mindset I have in terms of which industries to look out for and things like that within fundamentals. I truly believe market sentiment is a powerful tool, although it's easier said than done to truly master what the market sentiment is. Now, normally we look at market sentiment as what they're currently talking about, but there's so many things that are not being talked about that truly moves the markets, right? And so, with that being said, okay. Um, Now, with fundamentals, I like to look at everything. Going back to market sentiment, right now, there's rumors. There's rumors that there's going to be a recession. There's now data that's proving that we're going to have a recession. How big of a recession? We don't know, right? So these are the things that are just kind of barely spoken about, but carries a lot of weight. When the news focuses on words like recession, consumer debt, the highest debt right now is this month and last month. It's been getting worse and worse, signaling that inflation is really hitting the pockets of a lot of people. So overall, the market is reacting to that. The market's pure speculation. And that's where I go ahead and I look at, I'm going to go ahead and switch over here, share my screen. First things first, I look at the Bloomberg page. I kind of get the overall sentiment of what's happening. As you can tell, they're all talking about the stock decline. And right now, China is in the spotlight due to their advances and what they're trying to achieve, and it's not looking good at all. Currently, what's been mentioned but hasn't been fully been pushed out is the fact that companies are racing to get out of China. Again, companies are racing to get out of China. China has been, unfortunately, masking a lot of their earnings, their numbers and things like that. So it's really sketchy, even though they have a lot of great concepts. Unfortunately, that is the underlying issue that's kind of just kind of simmering right now. Just simmering right now. So with the whole issue with China, we're starting to now, with this inflation going up, with a global recession right at the tip of the scale, there should be a ton of acquisitions happening. A lot of companies are not going to make it out of this recession. And it's important to have that in the back of your mind when you're trading specifically the economy. When I look at the Dow Jones or the S&P, I don't really look at the NASDAQ as much, just because of what the NASDAQ is known for. I like to, I check it out, but it's not my main bread and butter. Um, I look at the overall trend. Overall trend right now. We had beautiful, beautiful years of a nice, swift uptrend. And at this point, we have to think to ourselves, okay, what's going to happen in the next couple of weeks? Now, a lot of our plays pan out eventually. The only thing is, sometimes we either come and we place a trade too early or too late. So when you're placing these trades specifically and you want to solidify a good return, go ahead and feel free to spend a couple extra dollars and go ahead into long-term plays. So currently, right now, it's looking like it's heading into a downtrend. Of course, as you can tell, this is just breaking through. And during bear markets, there's a lot of, again, companies that's going to be going out of business. But this is the time that you have to go ahead and peek your eye. This is where fundamentals, to me, is absolutely important, specifically when you are um, investing for long term. So a bear market is typically triggered by a combination of factors that leads to a prolonged decline in stock prices. That's pretty much what's happening now. For one, economic recession. When the economy is in a recession or experiencing a slowdown in growth, corporate profits tend to decline. Exactly what's happening. Number two, high interest rates. That's self-explanatory. It's all over the news. We're feeling it. And when interest rates are high, borrowing becomes more expensive, which of course hurts corporate profits, definitely consumer spending, and ultimately leads to a decline in stock prices, right? Now, third, geopolitical events. Bam, what's happening in China? What's happening in certain parts of the Middle East that we're not really talking about? What's talking about in Europe, Russia, Ukraine? Geopolitical events also trigger bear markets. Natural disasters, well, we had a couple earthquakes. The last big one was in Turkey, and that's where they haven't really spoken much about it after the situation, but we all know that that's an ongoing issue. On top of that, the United States gets hit by hurricanes and volcanic eruptions and stuff like that. Asset bubbles. This one in particular is what a lot of this, Wall Street and a lot of people are talking about, that a lot of these companies during the pandemic needed to grow quickly, right? Because everyone was staying at home. Everybody was tuning into the, home activities. Perfect example, Peloton. Peloton was one of the stars of the coronavirus. Came out with amazing products that truly were very expensive. But remember, you could only sell so much, right? And they had these amazing strategies to expand. They had this warehouse being built, and slowly, as people started coming back, that's when things started happening. So they started they stopped production on the manufacturing of the warehouse, and then ultimately they are now in a what I consider a buyout level. And again, another asset bubble is the tech industry. Huge layoffs, huge layoffs. They're the ones that are going to get hit the hardest. And so again, these are all main. And one more is a financial crisis. For example, the financial crisis of 2008, which I'm going to speak about in a little bit, was a housing bubble. Now we're looking at a tech bubble, right? AI right now is the talk of the town for tech, is probably the savior of tech at the moment. because everybody wants to get their hands on it. And once that happens, then of course we would have to look at some companies. The top AI companies right now that people are looking at are, of course, Google, TensorFlow, Cortana, IBM. When it comes down to the ones that are priced perfectly in my eyes, there we go, Palantir Technologies. That's the company. But Palantir is a great company based in Colorado that it's a pretty small company, but again, it's on a extremely great industry to be in, specifically AI. So keep in mind Palantir Technologies, and potentially, who knows, maybe Google's going to try to buy out, or some behemoth is going to try to buy out all these smaller companies. And at that point, that'll be a nice little spread to make. So I just went over 6 points on, what a bear market can be triggered and whatnot. Does anyone have questions before I go into the 2008 bear market? Cycles are divided into 4 stages. You got your expansion, your peak, contraction, and trough. During the expansion phase, economic growth and corporate profits are strong, leading to rise stock prices and high investor confidence. So let's go ahead and take a look at, I'm gonna go ahead and share my screen. There we go. Look at this gorgeous uptrend. This was from 20th of March of 2020 all throughout the 3rd of January of 22, right? Beautiful. If you were able to buy even properties or Bitcoin at this point, or excuse me, cryptocurrencies, all that stuff, look at this gorgeous uptrend. Now we're getting into very sketchy parts, because of course the peak was January of last year, and ever since then we've been hitting down this downward zigzag, and we're getting into this little area where it could potentially be a nice little consolidation area, but overall it's not looking good whatsoever. Okay, going back to that, so the contraction phase, also known as the bear market, is categorized by declining stock prices, economic recession, and investor pessimism. So what I recommend, if you are a long-term trader, or excuse me, a long-term investor, and you have your money invested in the market, take it out. My recommendation is to take that out, keep it cash. Cash is king during times of credit, which we're now going into, a credit times, I guess. Once you have that cash, do not take it out and put it into your bank. Just leave it inside your account and let the market do whatever it takes. But the point is not to take your money and let it go through the roller coaster, because it takes just as much time to regain all your losses than it is to just take out your money when times are uncertain, than to put it in when times are great. Understanding the market cycles can help everybody make informed decisions, and exactly the reason why I always look at the economy as a whole, instead of just particularly just companies here and there. And right now, everybody wants to sell. There's really not good market sentiment at all. And if you want to do your own small little case study, perhaps speak to 10 people. 10 random people and ask them what they think about the economy, and create your own kind of data. And then from there, also think to yourself, what can I do long term, right? If we were to take a trade from the beginning of this month, from the beginning of this month, we could have written it up halfway to the 6th of March. And if you can tell, ever since the 6th of March, which was just 3 days ago, it's been on a downtrend. So it's always good to just have an overall vision of what's happening. And then lastly, if we were going to figure out for those active traders that are trading the markets on a daily basis, it is absolutely key, which I said prior, it's key to understand where the entire market is going and ultimately how your index is doing that you're trading under. Because without that, if you have no idea how your index is doing, then you're pretty much, I would say, gambling. Because at that point, you have no idea what's happening outside the company that you're focused on. And generally, the bear markets last pretty long. We're talking about 2 to 4 years. We had an amazing couple of years with this beautiful uptrend and whatnot, but it seems like with these high interest rates, with all the things that trigger a bear market, economic recession, high interest rates, geopolitical events, natural disasters, asset bubbles, financial crisis, these are all primed for a bear market. So again, we're looking at an average bear market lasts about 2 to 4 years. Okay. But who knows? Maybe this time is going to be different, maybe not. But it's time that you or we understand where we are currently right now in 2023. All right, that wraps it up for me. If you have any questions, please let me know. Again, thank you so much. My name is Lucky, and yeah, I'll be here.